Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket Talker. I hope you had a nice weekend, a nice holiday weekend, and was able to kind of sort out all this confusion that's going on in Washington. The market right now is trading last in gold at 1834.30, up about 440. What I would like to do on this segment is to take a look at a report that we published in the Associated Press on the 13th, which has gotten quite a bit of responses, probably the largest response that we got on one article, which was over 41,000 viewers on this report. And the title of this report was Gold and Silver Are Getting Ready to Explode. And I think the word explode might have attracted a lot of criticism and a lot of support in that sense. So let's take a look and see what was written in this report. Volatility in gold is increasing as we deal with trying to resolve the political, health, and economic crisis. Unrest will continue to cause extreme volatility in the markets, including gold. Political concerns have overtaken pandemic concerns. Even so, the pandemic continues to damage the economy. Volatility in gold is increasing as we deal with trying to resolve the political, health, and economic crisis. The storming of the Capitol last week was significant. It has given many a pause of concern. It does not appear to be over by any means. Unrest will continue to cause extreme volatility in the markets, including gold. It has created nervousness in the market, which is creating more volatility. Even so, stocks continue to rise. Political concerns have overtaken pandemic concerns. Even so, the pandemic continues to damage the economy. Gold and silver this morning are rising as worries about the pandemic hurt stocks and help safe haven demand for precious metals. Tuesday, the U.S. reported a new record for COVID-19 deaths, and the Fed made dovish comments, which increased demand for gold. It looks like, as I read this, nothing has changed. In fact, it continues to get worse. Global economic data was bearish for gold, with the Eurozone November industrial production rising 2.5% month to month, which was stronger than expected and the largest increase in 4 months. St. Louis Fed President Bullard said the Fed must regain credibility that it will hit its 2% inflation target. And we're going to be less preemptive than we would have been. Okay, so they're saying they're not going to hold inflation back once it gets to that target. We're beginning to see increase in the CPI already. And it looks like we have come down to activate some major levels of support. So I want to go back here for a minute, and I just want to read this report that was published, which primarily is the VCPMI identifying the weekly pattern. This was the week of the 13th. The variable changing price momentum indicator is showing gold trading last at 1841.70. more or less where we are right now. It made a low of 1817 yesterday, which was a significant turning point. It came right into the VCPMI daily by one level. Below that level is a strong relationship at 1800 and 1798 between the daily and the weekly VCPMI levels. Gold then rallied right up into that monthly target of 1864. The daily target today was 1861, which was completed early this morning. We completed the sell one daily target of 1861 and the monthly target of 1864. Then it activated a short trigger at 2:45 a.m. Pacific time on the daily at 1861. These moves completed the pattern. We're getting a lot of action on the overnight Globex sections that makes it hard for you as traders to take advantage of the moves, but you can't make every trade. If the market comes down to 1822 or up to 1861, it will offer the highest probability trades. You don't want to trade around the mean, since there is a 50-50 chance of the market going up or down from there. You want to use the VCPMI to identify the extreme levels above and below the mean. Then you can buy or sell at those levels with the highest probability trades. The VCPMI offers 90% probability trades at the VCPMI sell one or buy one level, and 95% probability trades at the sell two or buy two levels. We are trading between the monthly average of 1864 and the daily average of 1839. Right above is the daily VCPMI sell one level of 1861 and the sell two level of 1878, which matches the weekly average of 1880 and the monthly of 1864. Those levels then become the target. Buyers are beginning to enter the market. It appears to validate holding a long-term position in gold. Since the March high of 2089, the market has been waiting to see how much damage has been done to the economy. Traders thought would be far more damage, and the market came down to 1767 last year on November 30th, which was about the low for 2020. The leg from 1767 to 1962 is almost a $200 move since November the 30th. This is just the beginning of volatility in the gold market. Gold and silver are getting ready to explode. The recent sell-off from 1962 to 1817 is about 50% Fibonacci correction. It looks like a second Elliott wave correction. The second wave is up to a 72% correction. When we establish the bottom of the second, then we start the third wave, which is usually double the move of the first leg. If the first move was 200, then the third wave should be about 400 from the low of 1817. In this case, the low was 1800, and we're going to take a look at the chart here in just a minute and review and see what has happened. So it should hit around the 2000 target, 2022. It also fits into the upper range of the long-term Fibonacci trend lines resistance all the way up to 2863. The VCPMI is identifying the start of the third leg. 1767 matches a 50% retracement from the March low of 1456 to the high of 2089. It seems that the next seasonal pattern is unfolding. The correction was a second wave correction. The second and fourth waves are corrected. Now, market volatility is increasing with a mixed short-term signal as it trades between the daily 1839, weekly, and the monthly average of 1830 prices, which is exactly where we are right now. The market is in a choppy area. It will probably trade with those average prices. Don't trade. Wait for the market to go to the extreme above 1878, 1880, or below 1800 to 1822 to trade. The low last night was 1800. Now we want to see what the market does from here. If we get above 1864 on the monthly, then it's critical for the bigger picture. The sell one monthly is 1950. The market almost came down to the monthly buy one of 1816, which has been in place all month. Right below that was the 360-day average price of 1810. So what's happened here is, let me finish this, and I'll get more into the current analysis. Therefore, that area was a strong area where a reversion was likely to unfold. Within a 10% margin of error, that level did prove to be the area where a reversion occurred. With a harmonic convergence of the daily, weekly, and monthly levels, we are seeing the bottom of the market become clear at about 1800, 1798, 1810, 1822. In that area, the market is highly likely to revert back up as buyers come back into the market. We are at or almost at the bottom of this counter trend correction, and we are using this correction to add to our long-term positions. Let's take a look at the market here and see what has transpired since that report was published. We have made a law of 1800 last night. And as you see here, coming into, let's say now, this week, we have the weekly numbers on the right side, and I also put on the monthly average just to measure the relationship of the daily to the weekly in relationship to the monthly. So what we're looking at on the daily is that we came in, and this was published over the weekend, basically for our private trader subscribers. 1812 was the buy one level. Buy two was 1786 as of Friday. And the market on Sunday night came down to a low of 1800.8. It came right into this area of support, or what we call the area of accumulation of supply. And reverted from here violently. And closed above the weekly buy one level of 1809 and the daily buy one level of 1812. It activated a very strong signal, with the targets above being the daily average and the weekly average, which were 1826 on the daily and 1836 on the weekly. So what you've seen here is the market unfold the signal as expected by the VCPMI, met the targets of 1826, 1836. And when neutral went, it got up to the average of 1836. Short-term traders, swing traders, this was your target if you took the signal from the 1800. Now, we've been looking at these levels here for a couple of weeks to be areas where you want to get long. If you want to get long with a high probability, these levels have been the ones that we've been recommending our traders, and also we've been executing ourselves. The market is reverting from where it appears is a high probability area of demand, because we are looking at the daily and the weekly activating signals closing above the daily average and also trading above the weekly average. So we're beginning to see the wave or the pattern unfolding into a bullish pattern, from a bearish to neutral to bullish now as it begins to activate the trigger points. Now, trading above the average daily of 1826 puts the target of 1851 into place for the day, unless it closes below 1826. That's your protective level for short-term traders that want to identify the shift in the trend momentum. We don't, again, my choice as a trader is to take the highest probability trades, but the VCPMI identifies from the average to the extreme above or the extreme below the momentum from 50 to 90% relative to the implied volatility to the mean. So if you want to take the risk, that depends upon how you manage it. Obviously, you can trade the average price, but be aware that the average price is very choppy, that once it enters into that zone, it could trade back and forth because it is a 50-50 standard deviation. And as a self-directed trader here, and what I'm teaching my traders is to take the highest probability trades only that you can identify. And that is by the market coming down below the mean to ideally the extreme below the mean, or by 2, ideally, which is a 95%. It's a 95% probability relative to the mean. It's a 2-to-1 factor. The by 1 is a 1-to-1 factor. So now we've met the targets short term. There are no trades to be done on the futures, and we're holding with the balance of our core position, waiting. If the market trades above 1836, then it will activate the weekly target of 1855. Let's watch the market here for a little bit here as it trades the average price daily and weekly, and it's in an area where it's considered very choppy. There are no signals. The signals came in, as I said, last night, and now we're finding ourselves again around the average price. The silver market as well has completed the pattern of the sell 1 target. Daily. From the extreme below the mean of the by 1 level of 24.29. And so this is from 24.29 to 25.47 with 24.76 along the way. That was a great trading range on the Globex. And this is what I mean when there's a lot of activity that's going on the Globex, but you come in here in the US session and we come in at the upper end of this range. And this is usually what happens. You go in, you get a lot of supply at these levels here as the signal is activated on the short trigger at 3:15 a.m. So this is one of the things that I try to manage for myself, and I suggest my traders here that be cautious when you're trading these instruments overnight, particularly silver, gold. They're extremely volatile instruments, and sometimes a lot of volatility can happen overnight. And so you don't want to be over positioned yourself. And if you're carrying a core position, you want to use these corrections in the market that we have, like we did earlier, to essentially build or add to your long-term position. My conviction here personally is that the price of gold is going to be much higher. I think we're going to see the price adjusted to the relative volatility of Bitcoin, to the relative volatility of the equity markets, the mini S&P. The crude oil markets are beginning to have very, very strong demand once again. And the commodity markets, particularly grains, are just exploding. So commodity prices are on the horizon without question. What we have yet to see is basically how fast these commodity prices are going to affect, the economy or Main Street. If it is not a short-term weather situation or an unprecedented, catastrophe, you might say. So I'm watching very much food prices here by simply tracking the soybean market, trading $13.88, $14, $14.36 was the high made recently, and this was from a low of $8 a bushel to $14.36. That's a phenomenal increase in price. It's more than a 50 or 60% increase in just the last few months, which is yet to be reflected in the retail level. In the past, government statistics have not included the energy markets, the food markets, because it has been considered a short-term anomaly. I think the difference of what we're looking at now is that this is not a short-term anomaly, but potentially an intermediate to long-term problem that we're going to have. This lockdown, globally and locally, has literally destroyed the supply chain once again. And what we're using basically is the current inventory and supplies available. And if you just take a look at real estate, for example, and if you price in, lumber or some of those basic items that are necessary to build, to construct, they have exploded in price. Home prices are at the lowest inventory level in many, many years. So we have a real anomaly between where the prices are, for example, in some areas like real estate, like the stock market, and yet The prices of commodities obviously are beginning to feel the impact of this tremendous stimulus that's coming into the market, which is eroding slowly the purchasing power of the US dollar as the reserve currency. And as you begin to erode the purchasing power of its currency, you begin to create inflation underneath, higher costs. Things cost more, less product. Have you noticed when you go to the market, sometimes some of the bags that you buy don't feel, they feel lighter and more expensive? The products that are being made right now are being cut in size, and even if it's the same price, it's showing an increase in its overall cost. That's what I'm finding out there, and I think that's how some of these companies are beginning to hide the real inflation factor that we have already in the economy. And I think that it is inevitable that as we open up the printing presses to staggering amounts of money that is beyond comprehension, that we could be reaching 10% of GDP just on stimulus. That's about $24 trillion that have been allocated, which is staggering. But we got to get this economy going. We got to support Main Street. There's a lot of demographics that are in dire need of help from the government. And unless we expedite and release of those funds without political interference, things are going to get a lot worse before they get better. Now we have issues with the vaccine. The distribution of vaccine, the supply availability, who gets who gets what, how much, who gets first. It's amazing how chaotic this whole system has become. And I think for the next few days, we're going to see a little more of what a banana country looks like. Truly. This is very similar to a third world country. The politics of it, the economics of it. And that is what really is rising the hatred of the extreme right. This is what happened in Germany. This is how Nazism was born in Germany, is when the economy was falling apart, when people were starving. And you get some fast-talking, charming leader, charismatic leader, to make promises that he can't keep. And pretty soon we find ourselves in a different environment than we really are comfortable with. I think we're moving into extremes, right, extremes left, and it's all because the economic system underneath is collapsing. And it's irrelevant, whatever political idea or system you have, if you underneath have an imploding economic system that would only reflect the ideology you have. And so far, I would think that where we're going here in terms of the U.S., is uncharted water. One of the things that I think the U.S. has as the ace, you might say, the ace card in this game is that the U.S. as the world's reserve currency can print unlimited amounts of its currency, as opposed to our creditors or our debtors cannot. All their assets are in US dollars. China, Russia. The US has been the world's reserve currency since 1971 when Nixon lifted the gold standard of the dollar, which was the beginning of a debt economy as we are beginning to see. And of course, through that process, we have seen a very elite group of people become multi-trillionaires as a consequence. But not Main Street, not the middle class, not the lower middle class. We probably have the biggest wealth gap in the history of the world. And I'm not sure how long that's going to last, but based on historical references, obviously, you get the people pissed off enough, it's not going to last. So we're coming to, I think, a point in the markets where things, are resolving themselves. This pandemic took the veil off, so to speak, of what was already a failed system, what was already a weak system, a system that was full of poison, a system that was full of debt. And unfortunately, what I think is the difference right now is that the central bankers do not have any room to manipulate interest rates anymore. On the face of world record debt and negative interest rates, with a global lockdown that has closed just about every sector of the economy globally. I fathom to really think, and I can't even think in terms of trillions anymore, because a trillion here, a trillion there, what's a trillion anymore? It used to be a million and then a billion, and now we're talking trillions like they're millions. And the word quadrillion is in the conversation as well. So I can only look to see how I can protect myself or how I can monetize myself out of the situation. I'm not an economist. I'm not a PhD by any means. I'm just a trader, just like you, that are trying to make a buck to maintain my lifestyle, my family, and not be affected, or to trade against some of this just ridiculous fundamentals that we're dealing with right now. That ever since March of last year, basically, we broke away from that physical economy, as we knew it before. And I keep referring to the fact that back in March of last year, when the price collapsed to 1451, this is when we shifted the price of gold, and the price of gold became a currency, and the US dollar became a commodity. And we've, after making the high of 2089, we've come down here into this consolidation, making a low last year of 1767, is right into this Fibonacci retracement, and here we are. We're at the beginning of what looks to be the second leg again that I pointed out in the article. Now, as we move into the end of this month, there is a likelihood that if this price holds here, that essentially validates and confirms that this is the low of last year, and this potentially we're making today, it could be the seasonal low. And so from this low, I'm looking at least a 2000 rally before we see some supply, or we see what the supply looks like at that point. So I'm comfortable where I am right now again, and today there's no real trades to be done, but you can see the daily, even the daily chart is putting in what could be a key reversal day after making a low. And if it closes within 25% of the high, it's considered a key reversal day, technically. But market, is trading on its own energy, so to speak. And what the VCPMI simply does for me is it identifies these levels that when it comes down, you see this reaction, and it validates exactly the demand that I want to see, the buyers that come into the market. So we're beginning to see buyers trading above 1836, which is good. There's more buyers than sellers here at this level. And as you can see, the choppiness back and forth. And so, but trading above 1836 definitely activates again 1851. The daily 1851 has been active unless a close of 1856. Now we're getting the weekly to follow with a target of 1855. And mind you that the analysis that I have done here today has pretty much been purely technical in its nature, because trying to make sense of these fundamentals certainly is anybody's guess, but what the VCPMI basically deals with is the energy, the volatility of the market, the momentum of the market. This is a momentum indicator. And when the price is trading above the average of 1836, it's activating the weekly momentum bullish. It's activated the daily momentum by trading above 1826. It's a momentum indicator that identifies the targets, the probability mathematically targets that you see, using pivot points, activating those pivot points into a perfect Fibonacci structure, gives us the wave count above and below the market for us to activate high probability trades, regardless of the fundamentals. If you take a look, and of course, if you put into the equation this environment that we're dealing with right now, highly volatile environment, anything can happen. In fact, it could be explosive for the gold market as we move forward. From a safe haven, a risk haven asset, and also an economic indicator. It's a multi-dimensional asset, particularly in silver, which could be industrial. It's affected obviously by the sentiment in the industrial sentiment, the demand. A weaker economy obviously translates to a weaker demand for silver. But when you take a look at the price at these levels, again, the most area across any other asset is precious metals, which is why I'm focusing on them. So particularly by trading on the long side, all surprises are going to be on the long side. All major surprises are going to be on the long side. $37.60, $37.70 offered. We're beginning to get more buyers above here, which is bullish, following the bullish trend momentum. Momentum traders may be coming in here. $18.38 offer, $18.38 traded, $18.10 offered. We're getting slowly buying come into the market here, which is a good sign. And that's what we want to see. $38.20 traded. So we're getting buyers that are taking the offers above the market, which is a good sign. We activated a bullish trend momentum on this bar. So now it's activated the 1855 target on the weekly, and the daily is 1851 alive and active. So we got now a daily and a weekly signal being activated. It almost looks like a double bottom formation in here that you see. A little more clear here if I expand on the chart here. We're picking up a lot of volatility once again. 38 traded. We've seen a little bit of reversal on the silver as well, following the pattern in gold. Silver holding its gain of 35 cents, up 1.42. So we are keeping an eye on silver in terms of volatility because it is lagging in the gold. It is lagging the gold. And we expect that the silver is going to have incredible volatility in comparison to the gold market. And this is pretty much how I use the VCPMI here to guide my trading, is like a GPS, as I say, that I use it to guide this pivot points, to follow the AI, the methodology, the application, the intelligence behind the algorithm, which is really what I'm sharing here. The intelligence that I'm sharing here is an algorithm that was written at C++ in easy language in TradeStation. It's actually an algorithm. And what I found is that because the algorithm is only one-dimensional in its nature, it uses a 1-to-1 factor, unless you want to increase your multiples and so on. But in terms of the directional signal, it provides incredible high probability entry points, exit points, and targets, enough that I, as a self-directed individual, can manage that risk accordingly. And this is what I'm teaching my trader subscribers, is basically how to apply this information intelligently, methodically, scientifically, and pretty much in a mechanical fashion. It's not a 100% guarantee. Nothing is, basically. But what I found for myself is that instead of using the fundamentals of the market, which are ambiguous and they tend to lag the market. For me, especially after we moved into this virtual economy that we're dealing with right now, it makes a lot more sense to use numbers. And I think as we move into this virtual economy more and more, and particularly if we begin to see some of the central bankers issue any kind of virtual currency, we pretty much are going to be moving into a virtual economy, a virtual world, which we are already involved in. I'm not sure personally how much this old physical economy is going to come back to its normality. I'm not sure that all these businesses that are literally in dire straits are going to be around for a long time. All the mom and pop businesses, the restaurants, travel agencies, and I mean, it just feels like an economic tsunami has hit the landscape, the economic landscape that is really adjusting, recalibrating everything. And I think, for myself, in looking at these markets, looking at the volatility, it's an incredible opportunity for self-directed traders like you and me to be able to take advantage of this. If you can afford the risk to trade these markets, I think they can provide for you unlimited freedom and unlimited potential to maximize your skills. Do your work. It's not easy. It's not for everybody. And what I find is that the more work you do, the more you learn how to become a successful trader. It will provide a very gratifying experience for you. Depends upon the margin call, I suppose. But overall, if you know how to manage that, it can really change your life. It's changed mine. And we're beginning to see some of my traders beginning to really embrace completely what this intelligence is doing and applying it accordingly. It's not, again, a guarantee, but it is a way to manage the market mathematically, technically, and let everybody trying to figure out pretty much what these fundamentals are trying to figure out. We can't do anything anyway. They already got it worked out and figured it out, and they already know exactly what they want to do, regardless of what administration it is. So I think all of this is irrelevant to what the market here wants to do, and that's pretty much what I'm looking here to do, and to share with you pretty much during this hour live streaming, how this tool becomes alive here and how I'm using this to trade the market and to really perform above average results. Once again, I think that the volatility is going to increase more and more over the next few weeks. I think particularly as we begin to see the new administration settle in the first 100 days and see more clearly the path, you might say, they want to take with regards to the stimulus and how they're going to deal with this pandemic. I think there is no doubt in my mind for sure that we need to supply more support to the economy. I think, unfortunately, it is one of those times where the long-term consequences have to be put on hold for a minute until we can resolve this current crisis and are able to help Main Street, come back to some kind of normality here. Continue to maintain your long position in gold, your core position, as I've been trading this market, in suggesting that you want to have a core long position. And the instrument depends upon your profile for risk and so on. But the actual direction of the market, I think, is definitely on the long side. And I think we've completed potentially what appears to be, once again, the seasonal low of 1800. And that was a great place to cover shorts. It was a great place to add to your long side. And so the target, what we want to see here for the rest of the week, is 1855. And ideally, we want to see the market come up to 1864. Right now, this 1864 is the monthly average, and it kind of matches the sell to level of 1866. So this is a critical area here, and I think that if we are able to get through this, we have 1883 in place, right above it, which is the sell to weekly level. Continue to hold your long positions. And once again, ladies and gentlemen, thank you so much for the opportunity to share this information with you. And I truly, sincerely hope that every day that you come here, you're becoming a better trader. Take care of yourself. I'll talk to you next time. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control.